The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. Ichi Tax.
It's Ask the Tax Lady with Esther Gulius and Ichi Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes. And we're going to tell you stuff on this program about some of the upcoming, well, it's not even upcoming anymore, the implemented tax law changes that you haven't read in the newspaper. And I will tell you, we're like chewing up the law, so we're going to give you some of the details. We're going to do it over a 2-week period. And next week we have a special guest, right?
We do. We have Dennis Kitchen, attorney at law. He'll talk about bankruptcies, real estate, general law questions. So
right. And so next
questions.
week, not only we're going to give you some of the other things in the tax law that nobody else has told you, but we have Dennis Kitchen that's going to be our special guest. So if you want to make sure that you have any legal questions ready for his bright mind, and obviously that's Tiffany Fabian.
Hey, and then also Dennis will be at our October 13th forum, our financial forum, or not really financial forum, tax forum called What's the Buzz? And Dennis will be there. It's going to be at the BBZ station, hence the name of the Buzz. And that's at the Eastern Hills Mall. And we'll also have us there, and we'll have Russ Gullo, and we'll have Jeff Katz. Right, we'll have Jeff Katz, Estates. We'll have a real estate person there. We'll have Social Security, which is Mike Hayfleck from the financial guys. We'll also have Boron
about health insurance.
Right, we'll have Boron there. We'll have Tim talking about health insurance. So a great time. So if you're interested in the seminar, don't forget to email us, or on our website there's a link.
And Chris, I bet you're feeling sorry over there. Nobody said hi to you. Hi, Chris.
Nobody likes me.
Fabian.
I'm going to go in the corner.
And he's got
itchy.
He's got a brand new infirmity, right, Chris?
That's
What's your
right.
brand new infirmity?
Poison ivy.
You don't get that in the winter.
No, let's bring on the summer.
Right. So Chris has poison ivy, but we're glad we're all here. 8030930. 8030930, star 930 on a cell phone. We love to hear what you have to say, whether you've gotten letters, you haven't filed, you owe the IRS. And obviously, another thing is we specialize in offers and compromise. So if you owe the IRS a ton of money, you know you're getting those letters from them. You don't even open them up. They're garnishing your wages. Ichi Tax can help you, right, Tim?
Yep. Offers and compromises. You know, it's basically if you can't pay the bill and you're insolvent, and we run through the numbers and we just see, and we furnish the IRS or New York State with 3 months of your utility bills, 3 months of your rent, and we fill out the forms for an offer and compromise, and we wait and see if they accept the offer, and it's
in their best interest to do
really
so, because they want to get you on the straight and narrow so that you keep paying your taxes, and it encourages you to go get a job. And work above board if you are working under the table.
I mean, there's so many things in New York State. If you don't pay your child care, if you don't pay your taxes, you can't get a license in many cases, and so it's
oh my gosh, it ruins your credit as well.
Yeah.
So, all right, let's talk. Chris, anything new at the office this week that you wanted to tell people about?
No, just the same old. If you get letters, don't pay them.
That doesn't mean never don't pay them.
Come to us first. We had a gentleman this week come in who got a letter, said he owed $60,000, so he wrote a check. Then he came in and he ended up only owing $20,000.
Wow. Which is a $40,000
swing. Yep.
And then it's hard to get it back. I mean, it takes a while to get it back.
It takes a while, and then if New York State sees the $60,000 instead of, it's going to, so.
All right, let's talk about some of the things that are in the tax law that nobody else has talked about. One of the things that I think is really interesting is kiddie tax. Why don't you guys explain to our vast listening audience what kiddie tax is, who it affects, the way it used to be? Then we'll talk about how it's changed.
Sure. Kiddie tax is your children on your tax return up to age 23 if they're a full-time student and has unearned income. So whether it's bank interest, scholarships, unemployment. Anything that's unearned gets taxed at the parent's rate. That's the old law.
Right. Well, they just simplified it. But now here's the rub, see? So what they said was now it's not going to be taxed at the parent's rate. Now if your kids have money, unearned income, like let's say grandma and grandpa's been given money and putting it into their portfolio, and you've been giving them money and putting it, and that's how you've been saving for college. Now they're going to be taxed at an estate or trust rate. This is already in stone, and so we thought this is really important because here we are at the beginning of June. You still have 6.5 months to fix it so that this doesn't affect your kid for next year. So what they're now going to do is tax your child's that would be your qualified dependent at an estate or trust rate. Now let me explain how that is important. If your kid had income from passive investments, dividends, interest, sale of stock, if that was over $2,550, they're going to pay 24% on the excess over $2,550. Under $2,550, it's 10%. If the money that they've accumulated from the investments are over $9,150, it goes to 35%. And if it's over $1,250, it's 37%. So if they have rental property, if they have, all those kind of things that parents can push off to their kids thinking, well, this is going to be cool for my kid, that they'll pay at a lower rate. The kid's going to pay at an estate or trust rate, and that's effective right now as we speak.
So that's higher than the parents' rate.
Well,
It could be.
Generally.
unless your parents are like the Rockefellers.
Right.
It's going to be higher.
Yeah.
Right?
Wow.
So you want to
huge.
make sure that if your kid has investments, that maybe you want to look at putting those investments into something that's tax sheltered, like maybe an annuity. And I know annuities are like, you shouldn't put them in an annuity. But in an annuity's case, it's not taxable till they take it out.
Right.
Or put it into, if the kid is working, into an IRA for them. If they're working, into a Roth IRA. All those things have tax-sheltered benefits, and nothing's going to be taxable on the return, and that'll save you money at tax time. So to reiterate, the change in the tax law is your kid who's got investments that you're claiming as a dependent on your return or qualifies as your dependent will no longer pay at your rate. They will pay at an estate or a trust rate, which in most cases is higher. And so that's already in stone.
And this is when we talk about tax planning. This is, as you mentioned,
really important.
Yep, very,
Right?
very important. Yep, something.
Okay, I'm Esther
a
Gulius, the
correction.
tax lady, 803-0930, 803-0930, star 930 on a cell phone. We're going to take a short break, and we'll be back on the other side. Hey, it's Esther Gulius, the tax lady from Ichi Tax. 803-0930, 803-0930, star 930 on a cell phone. I was with my mom this morning at Brothers of Mercy, and she's supposed to have a radio. So, Ma, if you're listening, hey, Ma, I love you, right?
Right.
All right. I'm Esther Gulius, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. We have a question on the text board.
It says, I'm turning 62 and will start collecting Social Security. I have a 17-year-old who will also be eligible until he is 18. Is his Social Security taxable? I thought this was a good question as it sort of parlates to kitty tax. Maybe they were
That's
thinking.
true. Maybe you were thinking about that. If your child doesn't have income, including half of his Social Security, that would exceed $25,000, then half of the excess over $25,000 would not be taxable. So that's a long way to say probably not. Probably 99.9%. It would not be, and it does not go on your return as well.
Right.
Just your Social Security goes on your return, which may be taxable. That part of the law has not changed. Right, Chris?
Correct. I was just going to say that. So.
All right. All right, so we're talking about some of the things nobody else has written in the newspapers or anything about the changes in the tax law. We've all heard about that 20% pass-through
Right.
for qualified business income. But what I was really surprised at is that let's say you have two businesses and one business made a profit
Okay.
and the other business had a loss. Well, like let's say business A, you made $20,000, but business B, you lost $50,000.
Okay.
Well, then when you net the two together, you have actually $30,000 in business losses. So obviously you're not going to get any of the pass-through because you didn't have any taxable income. But that $30,000 actually gets carried forward to the next tax year.
Oh.
Yeah. And so next year, let's say business A made 20 and business B made 50. So now you got 70, but now you got to reduce that qualifying business expense by the 30 you're carrying forward from last year, which means that instead of getting a pass-through on 70, you get a pass-through on 40. So it carries forward. And so
these are things that people aren't talking about.
And people didn't know. And I have to tell you, I kind of wanted to fall on the floor myself. I didn't know. These are some of the nuances. So it's really important because real estate is now qualified business income.
Right.
And many real estate properties are losing money because of depreciation.
Yep.
So your real estate may reduce your qualified business income on your other investment, thereby reducing the 20% that you get to pass through.
That was very clever.
Again, those are things that I don't think anybody else is talking about.
Right. Very clever.
I'm Esther Gullius, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. So in case, and just to give you an example, let's say your business is making, let's say you're a realtor, you're making $100,000. Well, with the new pass-through, 20% of the $100,000 or $20,000 is going to be, I'm going to say, an adjustment. It's a subtraction to income. So if you're in the 30% bracket, federal and state, you're going to save $6,000 in taxes. That's great. But if you have other forms of business income, like real estate, for instance, that's losing money, that can affect your pass-through.
Yep. Well,
because many of the things that used to be deductible aren't deductible anymore.
Yep. You could even have real estate agents who maybe last year it was a bad year for them, and they could have just started or whatever, and they lost $10,000. The next year they made the $50,000. Well, that loss of $10,000 is going to go to them next year
so
for the pass
through.
They'll
take 20 on 40.
Yep.
Right.
So it's going to impact a lot of people.
It is. So it's interesting. So in many people's situation where we would say to them, defer to next year the income, you might want to say get all the income that you can so you're not in that negative situation because it'll affect the next year's
God, that's completely
pass-through.
Different thinking than we used to think.
Yeah, we have to think differently.
Okay, there's another question, two of them actually. Is there a homeowner's advantage that was put in, this is a text question, that was put into effect last year? I already had my taxes done, of course, for 17, but I don't recall the specifics.
There's no advantage at
there's
all.
No
not
new home buyers.
As a matter of fact, there's being a property owner for more than a personal residence, since itemized deductions have changed so substantially, is not an advantage at all. As a matter of fact, if you have a second home, seriously look at putting that second home into investment property, or else you're never going to be able to write off, or in most cases, you're not going to be able to write off the mortgage interest or property tax.
But I can tell you, if you bought the house in 2017, make sure that you brought your closing statement, because you could have, for 2017, it sounds like you bought the house then, you could have done interim interest, PMI, and taxes.
She's right.
Points.
On your 2017 return, you want to make sure that you took into account, because last year it was deductible, interest that you would have paid, and this would only be found in your closing statement. Your PMI, your prepaid taxes, which again, if it was already if it was it was used home before, you reimburse the seller property taxes. So those are things you want to look at, because they would be an advantage, but not that it was any specific change in the law.
So make sure you looked at your closing statement if you bought the house in 17. And then there's another text question. Can one do an amended form if the government owes me money?
Of course.
Yes. Yeah, you could amend the federal, a 1040X, and you could amend New York State, IT20X, or whatever state it was.
Amended returns amend because you owe them, and you can amend because they owe you. and they'll pay you with interest. Federal government will pay you back with interest. So yeah,
3
go ahead and amend.
years.
You can amend up to 3 years.
Or 2 years from the date that you
paid
settled
your
the
taxes.
debt.
Right.
Right.
Okay. I'm Esther Golias, the tax lady from Ichi Tax, 8030930. 8030930 star 930 on your cell phone. And going back to some of the changes that are coming down the pike that nobody's really talking about. Let's say, remember the big thing about Donald Trump? He had lost like $750 million dollars, and he had a great big net operating loss.
Right.
Interestingly, the net operating loss used to be you could carry it back 2 years and carry it forward. Well, now they've changed. That's one of the changes that that happened. So now net operating losses cannot be carried back at all, and can be carried forward indefinitely. But only 90% of the money you lost is the carry forward. So here you really lost the money, but they only let you carry forward 90%. So that's another thing. The other thing is many people are aware of the $10,000 cap for the SALT, state and local taxes, that are going to be itemized deductions in going forward. Well, if you're married filing a separate return, only $5,000 of it is deductible under SALT.
Per person.
Per person. So if you're in the middle of getting a divorce, I would hurry it up, because if you're both single, it'd be $10,000 apiece. If you're married filing a separate return, it's $5,000 apiece. Right? So this is the best time ever to be divorced.
Yeah. And let's not forget, too, the IRS came back a couple weeks ago and said no shenanigans from the states. Our laws are the laws. They can't go and try to manipulate them.
Right.
So property taxes as a charity is a no-no.
That's exactly right. And then here's this is cool. And you people that love to gamble or love to go to the casino, one of the changes this year, and nobody talked about it that I've seen, is that now you can take you have your income that's taxable on line 21, and as an itemized deduction, your expenses up to your income for gambling, the cost of the gambling, is deductible. So let's say you won $25,000 at the casino in Las Vegas, and really you only have losers of 10. So you could take your losers of 10, but now they're going to let you take your travel and the cost of the hotel to make the money in Las Vegas. So it's not only your gambling expenses, the actual cost of gambling, you can add to that the cost involved and the expenses involved to gamble.
Cool.
Up to the income.
Could be good.
I thought that was kind of cool. So, and then the last thing I want to talk about this week, and again, we'll talk about more of it next week, is charities are now 60% deductible of your total income, whereas it used to be 50%. Right? I'm Esther Golias, the tax lady from Ichi Tax, 8030930, 8030930, star 930 on a cell phone, and we have Tom in Arcade. Hey, Tom, how can we help you, sir?
Hi, Esther. You just mentioned divorce.
Yeah.
Took quite the hit on the sale of the house.
Okay.
I wonder what might be deductible as a loss, if anything.
All right, Chris, tell them the bad news.
Yeah, well, since was your personal house, your losses are not deductible.
And the reason why most of your gain, unless it's very substantial, is not taxable either.
Your gain wouldn't be taxable up
Unless
to
it's
$250,000, $500,000 a married filing joint return. So gains on personal residence that you had 2 out of 5 year are not taxable at all. And so therefore they say the losses on a personal residence are not deductible. This was not rental property, was it, Tom?
No.
Okay. So nothing's going to be deductible.
All right.
All right.
Thank you very much.
Thank you, sir.
Yeah,
That's so sad.
And then Tom probably knows divorces that are finalized in 2019. Is it 19?
19.
For alimony, if you pay alimony, it's not deductible anymore. So make sure you pay attention.
So
if you have
and
questions.
here's the thing: amended, let's say that she takes, and this is important for ladies that are collecting alimony. If you take him back to court, I'm going to say him because my experience is mostly men are paying separate maintenance, and they amend that decree so that it's amended after 19, the alimony, then it's a change in the divorce decree, so that would be it's tax-free to her and not tax-deductible to him. So you want to I think this is something where it's still the jury's kind of out, so to speak, because that really encourages all women or people collecting alimony to go back to court because they would want to have it after 2019, so it isn't taxable to them. And that would just kill the person paying the alimony because it's not deductible to them.
Yep.
Under
So
the change in the tax
talk
law.
to your lawyer, get it done.
That's right. So make sure but the thing is, once 2019 happens, Chris, I mean, what would preclude somebody from taking their former spouse back to court to amend the divorce decree?
That's, I think I read where it's only divorces after. So if you're going back to court to fight it, your initial divorce was before.
Well, all right, but you know what they're doing right now. Nobody's ruled on it, so they're not sure what they're going to do. If they're going to say that if they're back to court and it's an amended divorce decree, whether that change.
I think
will
that's
affect
going to be a
them.
nice tax court battle.
Interesting
Precedent.
Yep.
I'm Esther Goulias, the tax lady from Ichi Tax, 8030930, 8030930, star 930 on a cell phone. And here we are, and we're approaching the news, but half the year is almost over. So on the other side of the hour, after the news, we're going to talk about mid-year corrections, things that you need to do now, not that what we just talked about wasn't important, because it is. But the first thing you want to do is you want to make sure that you get some mid-course looking at, because with all the changes that just went into effect, you want to make sure that your situation isn't, it's too late in January. So now's the time to change it. We still have all of June, all the way through the end of the year. So I'll see you on the other side. I'm Esther Goulias, the tax lady, 8030930, star 930 on a cell phone. See you on the other side.
Tony was there, and now he's gone.
What's that?
I said Tony was
Yeah,
there.
hey, I'm Esther Goulias, the tax lady from Ichi Tax, 8030930, 8030930, star 930 on a cell phone. I can't believe it that almost half the year is over.
I know,
Right?
it goes so fast.
And, I think when I talk to people, it's like deer in the headlights moments. They don't understand what's going to come down the pike in January. And so what we want to do is talk about what you can do before the end of the year to reduce your tax liability, because probably, I would say, half of the people that used to itemize are not going to be able to itemize in the future. And you may say, oh, well, they doubled my standard deduction. Yeah, well, they also took away your personal exemption. So you want to make sure that what you can do to reduce your tax liability, like, for instance, like we were talking about the kids with the kiddie tax, get them out of that because they're going to pay at a much higher rate, right? A state or trust rate. Okay, check your withholding. I just had my niece. She said to me the other day, Auntie Esther, are Mark and I okay? And I said, send me your pay stub, and I'll let you know. I'll project it out. And so she ended up with a projected refund of about $500, and they like it close to the vest, so that works for them. But what I did say is, have you maximized your pension contribution?
Right.
Because if they were to put more money in their pension plan, then that reduces their taxable income. So if you're not in your pension plan, and especially if you have a matching plan, I mean, you're literally throwing the money out the window.
That's right. And,
Right.
And so I was doing somebody's tax return this week, and he's a very high earner. And I'm like, why aren't you putting money into the 401k? And he said I should, and he said he will. So
I mean, but that's the whole thing.
Yeah.
You need to make yourself promises that, not that you should, but that you are going to, and you
Right.
should do it on Monday.
Yep.
Right?
Yep.
And baby steps are good to start with. Just do a baby step.
That's right.
Do something.
Do 1%.
So check your withholding, get into your pension plan, change what needs to be changed now. If you have a second mortgage, a home equity credit line, and it's not what's considered debt acquisition. You just took the money out to pay bills, and it's not a primary mortgage. Your interest is not going to be deductible. So give Ichi Tax a call, because we can show you what to do. Some mortgage companies are doing refis for free. Because they realize that the mortgage interest won't be deductible.
It's so funny. How is the IRS going to ever keep track of what somebody used their home equity? I'm sure they'll devise a way to figure it out.
Yeah, it's called an audit. You know, they send you a CP 2000 letter,
right?
And they say, "Gee, we saw that your mortgage interest was $5,000, but then you had a home equity of $1,200. Can you please provide documentation that the $1,200 is acquisition indebtedness or to make improvements to your home?"
Right.
I mean, that's what's going to happen.
Right. Yep.
Right.
Yep.
The other thing is, and just like we talked about a little while ago, second homes. You know, your vacation home. It's just a change of mindset. Instead of you saying, "Oh, I'm just going to let Aunt Susie use it, and I'm going to let Uncle Harry use it, and everything," and they're just going to give me maybe some money towards cleaning. You need to think about changing that second home into investment property. Why, Chris?
Why? Because the property taxes and the mortgage interest on, for second homes. Well, first of all, your mortgage interest isn't deductible anymore on second homes, but your property taxes and your income taxes withheld are going to be limited to $10,000. So the deductibility is going to be slim to none.
I wonder if you do.
But if it were rental,
if it was rental,
then it's 100%.
Then it's 100%. Yep.
Right.
I wonder if you did married filing separate and the house was just in that spouse's name and not in a joint union. I wonder if
So what about that?
I'm wondering if you could take the second house on the married filing
It's got to
separate.
be your principal residence.
Yep.
I mean, unless they're living apart, right?
Right.
But then she's still limited to 5, and he's
Right.
limited to 5.
Yeah.
On the property taxes.
Right.
Yep.
So, second homes are second, third homes. I mean, and many of you were writing off boat interest and RV
RVs.
interest.
Yep.
Not anymore. All right, and then evaluate your tax plan. Have you thought about starting a new business? There are existing businesses that are for sale that are making money, and part of the benefit of getting an existing business is that it has a net profit, and we know that one of the big changes is the 20% pass through. You guys want to explain that?
Yeah. So you mentioned it earlier, and Chris, you want to finish that story?
Yep. So if you have a net profit from a business, you can now
rental property.
Or rental
Or
properties. Yep. 20% of your net profit won't be an adjustment to income. It's a subtraction from income on page 2 of your tax return, so it's not going to impact your AGI. So if you have self-employment income, we'll say of $40,000, 20% of that is $8,000. So if your AGI is 100,000, we back off 8, so then you get down to 92,000, and then we take your personal exemptions, your standard deduction or your itemized deduction, no more personal exemptions to give us your taxable income.
Right. Which and obviously if you're 22% federal, 8% New York State, that's 30%, which would save you a nice chunk of money.
Mm-hmm.
Yep.
Right? So right now, for those of you that have rental property, real estate investment trusts, businesses, you should talk to your accountant about how this is going to affect your tax return, especially for those of you that have salespeople, or maybe you're an outside salesperson, or maybe you're a realtor and you're used to entertaining people, taking them to the country club for lunches and dinners and making the sale over the dinner. Not going to be deductible.
Right. Which
It's just
is
not going to be deductible. Your entertainment, even on a self-employed situation or on a business, is not going to be deductible. Your employees that travel out of town, if you're reimbursing them, you get 50% of that. Or if you have a business meeting where it's for the board members and everything, then that's the only thing that's 100% deductible. But the travel's still deductible, but meals aren't. And obviously there used to be one of my other clients was a part owner in a large garbage company. And he and his family are very wealthy. And they had all kinds of sport, what are those called?
The luxury
The
suites.
Thank you.
boxes.
They had 2 luxury suites, one for football and one for hockey. And I was saying to him the other day, does your brother know that he can't deduct that anymore? And he said, why?
Gulp.
He said, we've been deducting this for years. And I said, well, you can't
anymore.
anymore.
Under the tax reform.
And that's, what's so interesting, how no one really is talking about anything, because that's the big revenue in these new stadiums, these luxury suites. So once these companies realize that their $3 million a year suite isn't going to be deductible, how many of them are going to go vacant? Because
But more than anything, if you don't know, what you're learning here on Ask the Tax Lady, so many people don't know. And it really, really affects people's tax returns, the bottom line. Okay.
That's right.
All right. I'm Esther Gullius, the tax lady from Ichi Tax, 8030930, 8030930, star 930 on a cell phone. And we're going to go to Tom in Tonawanda. Hi,
Day
Tom.
for Toms.
Good day for Toms. Hi, Tom.
Hi, Esther. How are you?
I'm marvelous. What can we do for you?
Okay, my situation. My primary residence is worth, the mortgage is about $125.
Okay.
My rental property has a worth of about $175 with about $30,000 left on the mortgage. It'll be paid off in about 2 years.
Okay.
Would it be advantageous of me to refinance the rental property, pay off the primary residence, so I'm able to deduct the interest as a business expense?
That's really not a bad. Now, I will tell you, I'm going to hold my horses here, because right now some of the technical corrections have not been issued, but that certainly sounds like a plan, because you could, if right now they would say that as long as you haven't taken out more the profit. Right. Then you don't. Then you wouldn't have a problem. So that sounds like a plan that you maybe really want to start looking at, Tom, because then all of that mortgage would be deductible on your rental.
Know that the rentals will cover the mortgage.
Right.
And taxes, no problem.
Well, the taxes are the taxes. The taxes are an itemized deduction, but your mortgage indebtedness, unless they start calling it qualified. Purchase indebtedness, if it's limited to purchase indebtedness, then it would be a problem. So right now, there's nothing that says you can't. But before you do it, give us a call so we can do research as this all unfolds.
That sounds like a smart idea.
It does. This man's thinking. Okay, Tom?
I have the property. I might as well use it to my best.
That's absolutely correct, because I really do think that a lot of other people are going to be thinking about that say, okay, well, if I can't use the interest on my mortgage, but if I buy an investment piece of property, I can cover all of that with the investment piece of property, and it would be 100% deductible, which is correct.
Okay.
Thanks, Tom.
Appreciate it.
Good call. I'm Esther Gullius, the tax lady from Ichi Tax, 8030930. 8030930, star 930 on a cell phone. And we're going to take a short break, and we'll be back on the other side with your questions. Hey, it's Esther Gullius, the tax lady from Ichi Tax, 8030930, 8030930, star 930. And we're talking about really things that you need to do, because you got to put your thinking cap on. Especially in New York State, because we pay, mamma mia, in property taxes and mortgage interest and sales taxes and every other kind of tax. I heard Mike and Glenn kind of kvetching over that on the show before us, and it is true. And I will tell you, people in high tax states are not getting the benefit that people that are in low tax states. Give you an example. In Florida, they have lower sales taxes, but they have very low mortgage interest. So they're going to be able to take their sales taxes and their property taxes and their mortgage interest, on an itemized deduction. Whereas here, they're so large that people aren't going to get any benefit for it.
But in Florida, they don't give away everything for free.
They don't. They don't. And when I first got down there, I thought, gee, you'd think that with no taxes, this place would be just a junk bin, but it's really not. It's beautiful. Okay, let's go to the phones that we got. Mark from West Seneca. Hi, Mark. How you doing?
I'm good. How are you?
Marvelous. What can we do for you, sir?
I have a question about my 457 account.
Okay.
I plan on retiring at the end of the year.
Mm-hmm.
And I'm going to have the option of picking my retirement date. I could take my last deferral into my 457 either this year or next year. How soon after my last deferral can I start taking money out of that account?
Well, how old are you?
I am 51.
Okay, so that would be...
You're a state employee?
Yes, I am.
Okay, and you're retiring, right?
Yes, I am.
So
no penalty.
Right. So you're not going to have a penalty. So there should be no problem that you could take it out. You're not going to take it all. It would be redundant for you to put it in and take it all out. You're going to just take a small amount out, right, Mark?
I'm going to put in my last deferral in December, and then I'm going to start taking.
Right, but you're going to start taking it out. So let's say you have $500,000 in your 457. In next year, you might take out $40,000. There's no problem with that. It's going to be completely tax-free on the state, and there's not going to be any penalty on the federal. So you can start. But it wouldn't make any sense to put in $50,000 and then take out $50,000 in January.
In the same year.
Yeah. In the same year, because you just be if you put it in and take it out in the same year, it's going to wash each other.
Okay.
You follow me?
And I do. Do they take Social Security out of the 457 when you
No, that's a pension, so there's no Social Security withholding. They only do that from wages.
All right. So,
which is a really great thing if you think about it. That saves 15.3% on the two.
Well, I'm going to cash out about $30,000 in sick time. So my question is, if I put that right into my deferred, or most of that into my deferred comp account in December, can I take it out in January and save myself the Social Security tax?
No, because that deferral, you still pay Social Security on it through a payroll. That's still subject to Social Security and Medicare. It only saves you on federal income tax.
Maybe you didn't hear him, but that's what he just said before then.
No, he said if he puts it all into the 457, will he not pay Social Security?
Well, you're saying when he takes it out.
No, he's saying through his paycheck, when he gets his $30,000 lump sum for his sick time, when you put it in your 457, do you have to pay Social Security tax on that, correct? Mark?
Yes. Do I pay?
On the initial payment of that $30,000, yes, there will still be Social Security and Medicare.
Thought you didn't, right, because that's what he was saying. You're not going to get out of paying the FICA, Chris, right?
Right.
Okay, so I didn't think that you...
I got what he said.
Okay. Well, then I don't understand how you're saying that he doesn't pay.
When he takes it out of his 457.
Because it's a pension.
Right, because it's a pension. But he's saying his initial payment from
You're
the
not
state.
going to get out of paying the FICA up front, only when you take it out, because then it's a pension.
Okay.
Got it?
Second question. You were talking... I'm sorry?
Yeah, I said you got it, right?
Yes, I do.
Okay.
Second question is, I have about $50,000 in deferred losses on my Schedule E. Well, I didn't quite catch all of what you were saying before about losses not being able to be carried forward.
If you had a net operating loss, in other words, if you're a state employee, I'm sure you don't have a net operating loss because you probably have some substantial income. And it sounds like what you're carrying forward is suspended losses because your income's over $150,000, right?
Correct.
Okay. So those suspended losses you're going to be able to call up in the year of sale. So when you finally sell your property, those suspended losses are going to be called up and reduce the gain upon the sale. But that's not a net operating loss, so that's not what we were talking about before.
Okay.
Okay?
All right. Very good.
All right. Thanks, Mark.
Thanks, Russell.
Bye-bye. All right. Let's go to John in Grand Island. Hi, John.
Hey, how you doing?
Good. What can we do for you, sir?
Well, I'm. Where do I get the interest? Where do I get the tax rates for this coming year?
We got them on our website, don't we?
We have them on the website. And I could also email them to you if you want to email me at tfabian@egtax.com.
But if you go to our website, it's there as well.
Okay, I'll go to your website.
All right, it's egtax.com, and just take a look, and there's a whole section on tax law changes.
And that it'll give me the new rates, right?
That's correct.
Yep, because that's part of planning. So really smart to look at it. It's really helped a lot of people. I've noticed about 1/3 it helps, 1/3 it doesn't, 1/3 stays about the same.
Okay, John?
Okay,
thank you, sir. And we're going to go to Mike. Hi, Mike.
Hello, Esther.
What's new?
Well, hopefully my motorhome.
Okay.
I sold my old one and buying a new one.
Okay.
But now I understand that the interest on a second home is not deductible.
That's correct.
My home is paid for, my house that I live in. So if I were to take out a loan on the motorhome, it would be...
Not deductible.
It's not deductible.
Correct.
What if I take out a mortgage on my house and I use that money to pay for the motorhome?
All right. For everything I'm reading, they're saying that what's deductible is qualified acquisition indebtedness. So to acquire your home or to make an improvement in your home is going to be deductible. So right now, I believe that won't cut the mustard.
So it's not going to matter.
I don't think so. You can call the office on Monday, John, and we'll do some further research. But everything I'm reading, and I just got done reading
330 pages.
330 pages of tax law changes, and everything that they're using, the words are qualified acquisition indebtedness.
So the motorhome would have to be my primary residence.
Right, and that's tough. I bet your wife would divorce you for sure.
Yeah, she already did.
Good try.
I guess I'm kind of up the creek here. Okay.
Yeah. All right. Thanks for calling, Mike.
Okay.
Bye-bye.
And I don't want to add salt to his wound, but sounds like the kind of motorhome he's buying, he's going to have a lot of sales tax, which won't be a lot. Most of it won't be deductible.
Absolutely, that's true. And wouldn't be the first person though that started a rental. If he turned it into a rental business,
or turned it into a business.
Well, that's what I mean.
Well, either.
So if he started renting,
traveling,
because let's face it, all of my friends that have motorhomes, my one friend uses it 2 weeks a year, and the other 50 weeks it's vacant. Now, if he turned that motorhome into a rental, so he started renting it out, right, and turned it into a business, then all the interest would be deductible and the sales taxes.
And people are going to do things like that.
And they need to. They need to.
Yep.
Right? Okay, let's go back to the phones, and we got Jim on a cell phone. Hi, Jim.
Hey, how you doing?
Good.
Thanks for providing great information.
Well, thank you.
In our community. I had a quick question. Well, last year, prior when I was going to college, I consolidated my student loans before the rates hit the floor. I was locked in at 8.5, and I was paying it, and I had about $20,000 left. And last year, I took a line of credit out and basically paid off my student loans with that, and I lowered my rate from 8.5 to where it's at now. I think I have it floating at 5.25 with the bank. Are you telling me that I can't write that is not deductible interest anymore? If I would have left it as a student loan, it could have been still deductible?
Well,
up to $2,500.
Personal loans haven't been deductible for years and years and years.
He said a home equity. Didn't you say a home equity?
All right.
Yeah, home equity line of credit.
Okay. Yeah, that's not going to be deductible.
It used to be, won't be anymore.
Right.
And you're right.
But I'm going to tell you, you did a good thing.
Yeah,
you
the
saved
interest
yourself
rate
3%.
from 8 to 5.25.
Yep.
And the new reform is only for 6 years, which I guess is a long time. But I think
or
Esther's
until
right
Congress changes the law. And I'm going to be very surprised if some of these things that they took out isn't going to go back in. But what's something that you might want to do is, have you called, if PenFed is a great credit union, and they have very, very low home equity credit lines. So have you gotten the best rate that you possibly can, Jim? Have you looked around to see if you couldn't get a lower rate on that home equity?
Or some people, couldn't they refinance their home equity into a primary?
Right.
Get a new primary.
But again, it's all going to be, it's supposed to be acquisition indebtedness.
A little bit. You mentioned a credit union?
Yeah, PenFed, PenFed.org. Take a look at them because I'm pretty sure that their home equity stuff is about 3.5% to 4% with no closing costs.
Oh, nice.
So go take a look. That's the only other way to skin the cat right now.
Yep. All right.
Okay?
Yep.
Thanks for calling.
But he did make a wise move.
He did. He did a great
thing. Who would have known?
Okay, Mr. Jim for Gasport. How are you, sir?
Good. Hi, guys. How you doing?
Good. What can we help you with?
Okay, so I own my home here in Western New York. I'm 67, retired, collecting pension, Social Security. I bought a place in Florida last August. So there's taxes on it, of course, and I have a small mortgage on the place in Florida. Is any of that deductible?
No, not if it's your secondary, not if it's your second home. What you need to do is make that, if you want to have it be deduction, is make that home in Florida a rental so that you can use it part of the time personally. You can use it 14 days or 10% of the time it's rented personally. So if it's rented for 200 days, you can use it 20 days personally plus time that you're there for rehabbing it. But if you're going to make it just your little love nest down there in Florida, it's not going to be deductible.
Yeah, I live there 6 months, and I stay up here 6. That's the plan, so.
Yeah, well then, okay. Jim, thanks for calling. I'm Esther Golias, the tax lady. If you need help during the week, go to our website at ichitax.com or call us at our corporate headquarters at 632-7886. Until next week, I'm Esther Golias with Christopher Fabian and Tiffany Fabian. God bless you. Have a great day. And Father's Day's coming up, too. Don't forget.